Welcome back. As the MPC ends its meeting later today, consensus opinion is that status quo will be maintained. Analysts also expect further CBN intervention in the forex market. Let's look at the commodities market ahead of the CBN's decision. Amaka Ajebu, research analyst with Financial Derivatives Company, joins me now. Good morning, Amaka. Good to have you.
Thank you for having me.
It's always a pleasure talking to you from the side.
Yes.
Right, so talk to us about the commodities market. How is it ahead of the MPC's decision?
Yes, so as you said, everyone is anticipating the decision, but the consensus opinion is that the MPC would maintain rates at current levels. So that neutrality would also transcend into the commodities market. So we don't expect any direct impact of this decision on price movements.
So what if the MPC eventually decides to go the other way? What are we likely to see?
Okay, so the other way, by you mean cutting rates? You mean cutting rates?
Yeah?
Yes. Okay, so if the MPC decides to cut rates, that typically frees up funds for spending. So savings is not as lucrative as it would be when in a higher interest environment. So people will go out and spend more. So the higher the demand, the higher the price. So you can see that impact. And also from a supply side aspect, the lower the cost of borrowing, the more these manufacturers will have access to funds to fund their production process, and that will feed into higher output in the economy.
Now, aside from cutting the rates, let's look at the FX market, which of course is the burning issue in all of those things.
Yes.
What are you expecting to hear the central bank say?
Yes, so we're expecting them to move towards the direction of, increased intervention in the market and, setting the path towards a more liberalized exchange rate market, because they can see the impact of their intervention policies and what it did to the naira. So the naira has found a resistance level at 445 naira to $1. So this will help the central bank make their decision towards a more flexible exchange rate system. And typically with this, you will see more activity in the market. So manufacturers have the access to the forex funds that they need to keep up operations in the market. So this will be typically good for the commodities markets. Now,
the fiscalists, if I would call them, are really pushing for a lower interest rate.
Yes.
Would you think they are justified to do this?
Yes, from their own perspective, you can understand why they were pushing for a lower interest rate environment, because they want more spending in the economy to reflect the economy, to make increased activity and pull us out of a recession. But however, at the same time, this isn't, from the monetary policy perspective, it is not the right time, given the fact that, fundamentals are good, yes, but things are just starting to look up. So they from a monetary policy perspective, I wouldn't just tweak down the rates just yet. I would wait for, sustainability to be established in the market before I go ahead with this.
And particularly considering the global situational factors?
Yes, exactly. So as we know, US is currently in a tightening cycle at the moment. So this means that interest rates are higher in that environment, and that typically shifts investments from emerging markets to the US. So it wouldn't make sense to cut rates now and make our investments less lucrative at this point when the dollar is getting stronger.
Now, what is your outlook for the interest rate environment in Nigeria?
Yes, so we expect that interest rates would, towards the end of the year, take up that accommodative stance that the MPC is gunning for. But right now, like I said, the Monetary Policy Committee is still trying to establish this sense of sustainability in the markets before they progress towards that agenda.
All right, thank you very much, Amaka.
Thank you for having me.
All right, let's just hope they come out with something positive.
Yes.
Right.
Thank you.
Amaka Ajebu, research analyst with Financial Derivatives Company. Let's quickly take a look at the energy markets. The oil and gas index, of course, recorded the largest gain at Monday's trading following demand for Mobil and O&O. The other stocks there remained unchanged. And of course, the daily index return there was 0.95%, year to date 6.2%, price to earnings 17.5%, dividend yield 2.2%.